So today we've announced our half-year results to the market, where we've reported another period of growth right across our business. The growth has largely come from our luxury portfolio, wines that sell for $30 and above, which continues to perform well in the face of tougher economic conditions for consumers around the globe. Each of our three commercial divisions delivered improved revenue per case, improved earnings and margin expansion, with savings right across the supply chain and targeted price increases improving our profitability per case. The trends we're seeing across the wine category remain broadly consistent too. As we have now emerged from the pandemic, premiumisation continues, which means our consumers are drinking less overall but drinking better and are prepared to pay more for high quality wines. In line with this trend, the amount of commercial and entry-level premium wines, that's wines that sell for around $15 or less and typically have a smaller profit margin, have declined this half. Reflecting this trend in our results, we continue to see the proportion of our revenue be more towards premium and luxury. So let's have a look at each of the divisions' performance. Penfolds has continued to grow demand in a number of its key markets, delivering on its strategy to attract new consumers to the brand and become the global luxury icon. Earnings and revenue increased, driven by portfolio growth in Asia, EMEA and Australia. And there's plenty of highlights. The Penfolds collection, for the first time, 3 countries of origin in one collection. The launch of One by Penfolds in China, our first Chinese wine, and Venture Beyond, our campaign that sets the bar for events and consumer engagement worldwide. The Treasury Americas continues to perform really well in our sector. The declines in volume and overall revenue were partially offset by strong luxury performance, while earnings and earnings margin both increased. Frank Family Vineyards shipped well ahead of our plan. Strong demand drove this, and we've seen incredible momentum behind BV in this half as well. The luxury business is in great shape. While we've seen a softer start to the year in our 19 Crimes Australian portfolio, outside of the innovations, Snoop and Martha partnerships, innovations that continue to set the benchmark, we've got big plans for the brand that I can't wait to share with you over the next half. In TPB, volume and revenue declined due to less commercial wine being sold in Australia and Europe, which was partly offset by growth in Southeast Asia. Importantly, the proportion of premium and luxury wine contributed positively to revenue overall. And this shows, while there are trends we need to adapt and respond to, TPB's strategy is working. And our results also confirm that leading category innovation and inventiveness is so important to the future of TPB, across all our divisions as well. And we've had some great wins. No and low alcohol wine continues to build a category we see as increasingly important. New formats, magnums, or the magnum in a bag. Fantastic to see that launched. And from a sustainability perspective, Lindeman's shifting from glass to recycled plastic in the Nordics. Another great win. So as we look towards the remainder of the year, the priorities remain consistent. And while we must be prudent in costs in the current inflationary environment, we'll continue our disciplined investment in key priorities that fuel our long-term success. We'll continue to elevate our culture and build capability. Technology that strengthens our competitive advantages right across our business. And we will accelerate our focus on becoming a leader in sustainability. The other thing we'll keep doing is pursue innovation, and we'll also look at complementary M&A. So again, hasn't changed. So in summary, we're halfway through our 5-year strategy, our TWE 2025 game plan. Our position is in line with where our expectations were, slightly even ahead, and we've delivered strong progress this half. So as we look to the remainder of the year, we expect trading conditions to be broadly consistent with those of the first half, and we remain on track to deliver both stronger EBITS growth and EBITS margin expansion in fiscal 23.